Hello everyone. In this particular problem, we are going to go through various journal entries and see the debit credit analysis, and then from there we're going to go through the postings to the ledgers to prepare lastly what is known as a trial balance, which is a listing of all the running balances. Okay, so we have a company here. They organized in the month of June. So it's the name of the company is Aerial Views. They began operations immediately. On June 1st was the first journal entry of the year. So we're going to work through all of these journal entries that are listed here. And what we have to do is we have to analyze the transaction that was given to us, and then we need to put it into the appropriate journal entries. So June 1st, and we can see this is typically the first journal entry of any given organization when it starts to be in existence. Number one, the corporation issued 60,000 shares of capital stock to Wendy Winger in exchange for $60,000 cash. So what's going on here is there's an individual, Wendy. She's giving $60,000 cash of her personal funds to the business. In exchange, the business is going to give her ownership shares or stock in the business. And so what the company is going to do, if you recall, the general journal looks like this. We basically have the first column is the date. And then what we're going to do is we're going to list the debit first, and then we were going to indent and list the credit second. And so the journal entry that is required in this case is the company's cash account is going to increase. Remember, cash is an asset. Assets increase with debits. In addition, the company is going to issue stock to this particular new owner of the business. So the capital stock, which is an equity account, that will also increase. And equity accounts increase with credits. Remember your debit credit analysis. We have our accounting equation. Assets equals liabilities plus equity. On the asset side of the equation, they increase with debits, decrease with credits. But the opposite side of the accounting equation, it's the opposite is true. They increase with credits and decrease with debits. In every journal entry, the debits will equal the credits. Okay, next, June 2nd. The company purchased a plane from Utility Aircraft for $220,000. They made a $40,000 cash down payment and issued a note payable for the remaining balance. So in this case, let's analyze it. We, as a company, received a new asset, an aircraft, for $220,000. That is an asset. Assets increase with debits. Now, we wrote a check for $40,000, so our asset cash is going to decrease, and they decrease with credits. The difference, or $180,000, that is a new loan. It is a liability. Liability called notes payable, and liabilities increase with a credit. You can see this is called a compound journal entry because more than two accounts are affected. In this case, we have 3 accounts that are affected. But the most important thing to understand is every journal entry, the debits are going to equal the credits, which is the case here even though 3 accounts were affected. The credits are broken down into 2, but they total $220,000, which is the same as the debit. Okay, June the 4th, we paid Woodrow Airport $2,500 to rent office and hangar space for the month. So we are in June, and we're paying June's rent for $2,500. This is an expense. Expenses are increased with debits. Now remember, expenses, they're part of the red accounts. Remember, R for revenue, E for expenses, D for dividends. These red accounts ultimately will get sucked up into the retained earnings account. I called the retained earnings account the vacuum. So the expense will ultimately be debited, which reduces overall equity. And we wrote a check, so we reduce cash with a credit. Okay, then 11 days go by and nothing happens. I guess we're getting situated in our office space and we have our new aircraft. Now we took some photographs for our first customer, aerial photographs, and it says we billed those customers $8,320 for the aerial photographs taken during the first half of June. So what we're going to do here is we're going to record revenue. And remember, the rules of accrual accounting are as follows. Revenue is recorded, or recognized is the appropriate accounting term. Revenue is recognized when it is earned, regardless of when cash is collected. So in this case, if you take a read through this again, it says all we did was bill customers for work we already did. So the question is, did we earn our money? And the answer is yes, we performed all of the service that we needed to. So we can record that revenue, and we will do so with a credit. Revenues are credited, and ultimately they increase the retained earnings of the equity account. And we didn't collect it, all we did was bill. So we're going to increase or debit this asset called accounts receivable, which means we're waiting to collect from our customer. Okay, next, June 15th, we paid $5,880 in salaries earned by employees during the first half in June. This is an expense. Expenses are recorded when they're incurred, regardless of when we pay for them. So the question is, did we incur this expense? Yes, we certainly did. The employees worked for us, so we incurred the expense. We will debit salaries expense. Once again, expenses get debited, which ultimately decrease the equity, the retained earnings account. And it's actually payday. It said we paid it, so we will reduce cash with a credit. Next, June 18th, we paid Hannigan's Hangar $1,890 for maintenance and repair services on the company plane. So this is very similar to the last journal entry. It's an expense that we've incurred, meaning our vendor gave us service. So we do have a valid expense, and expenses are debited, which ultimately will reduce equity. And we wrote a check, so we will reduce cash with a credit. 7 days later, on June 25th, we collected $4,910 of the amounts billed to the customers on June 15th. So what we're doing here on June 25th is we're not recognizing more revenue. All we're doing here is collecting on receivables that we established back on June 15th. So if you go back up to June 15th, you remember we recorded this receivable of $8,320. Well, what we're doing here 10 days later on June 25th is we're collecting some of that receivable. So we will increase the cash account with a debit, and the receivable account is going to decrease with a credit. Remember, these are both assets. All we're doing is swapping one asset for another. All right, and the rest of them are year-end, or I should say month-end journal entries. June 30th, we billed customers $16,450 for photographs taken during the second half of the month. So all we're doing is billing our customers. We earned our money, so we can record the revenue, and we will do so with a credit to the revenue account. Revenues make equity increase. That's why it's credited. And all we did was bill our customers. We didn't collect yet. So we have to establish this asset called account receivable with a debit. June 30th, we paid $6,000 in salaries earned. So this is very similar to that June 15th journal entry when it was payday. We're going to increase the salaries expense with a debit, and we will reduce the asset account cash with a credit. June the 30th, we received a $2,510 bill from Petree Petroleum for aircraft fuel purchased in June. All right, so this is fuel that we purchased. We received a bill from our vendor, and we didn't pay it yet. It says the entire amount is due to be paid July 10th. But the bottom line is we need to recognize the expense in June, even though we didn't pay for it yet. So we will increase the liability with a credit called accounts payable. Now remember, expenses are recorded when they're incurred, regardless of when we pay for them. Here's an example of us paying for this expense afterwards or later, after the incurrence of the expense. And last but certainly not least, June 30th, we declared a $2,000 dividend payable on July 15th. So with dividends, there is something called a declaration date, and the board is actually the ones that vote on declaring a dividend. And they did. They declared a $2,000 dividend on June the 30th. That is when the dividend is going to be recognized. And so we will debit a dividend account. And remember, the dividends will get ultimately reduce the retained earnings account. And they work like expenses, but they're not expenses. So they're dividends. And we didn't pay for it just yet, so we're going to increase this liability called dividends payable. This is the first step in the accounting cycle. We're journalizing. We're recording the journal entries in the original book of entry, which is called the General Journal. And all of these debits and credits, what we do after we record the journal entries, we then go through the second step in the accounting cycle, and that is called posting. Basically, each account has their own ledger. And basically what we see here are all of the ledgers. And what a ledger is simply all the details and the running balances in each account. As an example, cash. On June 1st, if you go back to the journal entries, you'll see we debited it for $60,000. So that's our new running balance. Because it's a brand new company, the beginning running balance was 0. And so this first $60,000 represents the new running balance. Now the next day, June 2nd, do you remember we bought the aircraft and we put the down payment of $40,000 down? So we're going to credit the cash or decrease the cash. Now what is our new running balance? It's no longer 60. It's 60 minus 40 or 20. The running balance or the normal balance is always the side of the account that makes it increase. So cash is an asset. Assets increase with debits. So these running balances are always the debit balance. So after all of the debits less the credits, at the end of the month, the balance in cash, the running balance or normal balance is $8,640 debit. Aircraft, it was only one transaction. That's our running balance. Accounts payable is liability. They have the opposite. Running balances are credits. Okay. We have, accounts receivable is an asset. And after the 3 transactions, the running balance is $19,860 debit. Note payable is a liability. Dividends payable is a liability. They have credit balances. The stock account is an equity account. Equities increase with credits. Dividends makes equity decrease, so it's got a debit. Revenue makes equity increase, got a credit, and all the expenses are going to have debit balances. So the last step that we're going to go through in this particular problem is we're going to take all of these running balances, every single one of them. You just take the bottom running balance in all the accounts, and we prepare what is known as a trial balance. A trial balance is simply a listing of all the running balances. You can see we have 3 assets, and their running balances are debit balances. Remember, the running balance is the side that makes it increase, a debit or a credit. And assets increase with debits. We have 3 liabilities, notes payable, accounts payable, dividends payable. They're going to increase with credits. And then our equity. Equity increases with credits and they decrease with debits. So the capital stock will increase equity, has a credit balance. The revenue makes equity increase, it's got a credit balance, and the dividends and the expenses make equity decrease. So they're going to have debit balances. And you'll see at the end of the period, the debit column equals the credit column. And then from this trial balance, we're going to go through an adjustment process. And then from there, we will have an adjusted trial balance, and then we're able to prepare financial statements. So that is basically the trial balance, putting together the trial balance from the running balances in all the ledger accounts. This is the balance sheet. If we were going to put one together at this moment in time, we'll list out all of our assets, and there's your total, $248,500. Assets equals liabilities plus equity. So The liabilities, we have 3 of them. They're listed here, and that's the total. And so if the assets equals the liabilities plus the equity, we can basically plug in the equity being the difference between the assets and the liabilities.